Hi, Mr. Forbes. By way of introduction, I am Sanatya Singh from Economic Advisory Team. I appreciate the opportunity to present my analysis on the Great Recession of 2008-2009, the causes and the response from the government to the crisis and the lesson learned. In this presentation, we will overview the agenda for the discussion would be the overview, the two major causes of the Great Recession, the fiscal and the monetary policies which led to, during, and the after, and the policies and the actions to avoid future recessions. The Great Recession was a period between December 2007 and June 2009 that saw the 2008 financial crisis. It was one of the time we saw post World War II, we saw the worst unemployment rate, GDP, and the economic disaster in the market. It was mostly a consequence of worldwide banking crisis. The unemployment rate skyrocketed to 10% in October 2009. More than 326,000 workers were laid off who filed unemployment insurance. Around 3 million households were foreclosed. The Great Recession was brought by several factors, mostly related to the foxpaw in the housing and the banking industry, the subsequent effects of the devastated US and the other economies as well. Coming to the hypothesis 1, subprime mortgages. The federal policy and the Department of Housing and the Urban Development, they provided guidelines to Fannie Mae and Freddie Mae to accept smaller down payments and permit the borrowers to get more loans related to their income. Now, these high-risk mortgage loans were allowed for to the low-income group and the poor credit uh, at that moment led to they purchased homes that they could not afford long term, because what happens is in 2002 and 2004 there was the low interest rate with the Fed policy was provided. The federal interest rates increased in 2005 and 2006. So people who could afford home during 2002 2004, they couldn't afford to pay when the Fed rates increased heavily. The arm loans, which is adjusted rate mortgages loans, increases from 10% in 2000 to 21% in 2005, and post after that it was a reset down. Now, the result of 2002 and 2004 was more and more high risk mortgage were allowed to the subprime borrowers, but the result in 2005 and 2006 was the default and the foreclosure rates increased for the prime and mostly the subprime borrowers. The Great Recession caused 2, the high debt income ratio of households. According to the Board of Governors of the Federal Reserve System and the Bureau of Economic Analysis, at the peak, the household debt, which included the mortgage, the automobile loans, and the unsecured loans, was actually 1.2 times higher than the personal income. This led, and at the same time, it was fueled up by the increased Fed rate as well as the leveling of the houses prices in 2006 and 2008. It caused great number of foreclosures, and that's how it burst the housing bubble. The fiscal and the monetary policies prior were the reduced mortgage standards. The Fed policy supported low interest rates. The adjustable rate mortgage loans were increased to 21% in 2005, and the home prices soared, propelled by the subprime lending, and then they tanked during the credit crisis. You can see the prices on an approximate July 2007 to 2009, they fell drastically, although they recovered in some time little bit, but the burst was heavier. The fiscal and the monetary policies during the Great Recession. The government introduced TARP, Troubled Asset Relief Program. It actually helped bail out the likes of General Motors, Chrysler, and Bank of America, and other AIGs and others as well. In the graph, we can see the 2008 quarter 4 was the worst. That's where we see the V shape, and the government and the economy started recovering post after the different policies when they started to bail out these bigger giants. The American Recovery and the Reinvestment Act era provided funds to create and preserve jobs and expand unemployment insurance. And that was a great safety net program, including the food stamps as well. The fiscal and the monetary policies after the Great Recession. President Barack Obama signed the American Recovery and Reinvestment Act in Feb 2009, which actually provided 787 billions for these foreclosure relief, tax cuts, and all. The Dodd-Frank Act, which was passed in 2010, it actually gave federal government the ability to take over the banks if they were on the edge of collapse. And after the Dodge Bank was passed, the unemployment rate reduced heavily nearing around 2014. The employment rate went over the unemployment in the graph from the Bureau of Labor Stats. The biggest change in the economic era was the end of the investment banking. The Goldman Sachs and the Morgan Stanley were converted to the bank holding companies. The Dodd-Frank created standards for safe mortgages and established the Consumer Financial Protection Bureau to make sure the American families are not stripped of their wealth again as a result of predatory measures and the companies in the market. The government introduced more regulations for banks, also more consumer protection laws. The economic policies and actions to avoid in future recessions. The reduced interest rates to encourage investment, and that helps in the surplus amount of money to be established in the economy, so that more and more employment could be introduced with the throughput output. The second would be the focus on the expansionary fiscal policy with higher government spending and the tax cuts. The tax cuts allows people to have more money to spend for the entrepreneurs to expense and invest in other things. The higher government spending would also allow increased GDP, which is ideally equal to increased output. It helps in the increased employment as well. The third would be to ensure the financial stability by providing guarantee for the bank and the mortgages and the regulatory scrutiny of the banks. The investment banks like Goldman Sachs and Morgan Stanley, they were converted to bank holding companies, and more consumer protection laws were introduced to ensure at that moment. But the same thing has to be continue, and the government need to look into the cycle of the economy, how the economy is in which phase, and based on that they need to introduce either an expansionary policy or sometimes a contractory policy to de-escalate the risk and make a balance between the price stability and the maximum possible employment. Thank you. These are the references used in the preparation of the analysis. Thank you for your time. Good day.